All right, let's get going. Thank you so much for joining us today. We're putting on a webinar series called What Every Business Owner Needs to Know, trying to get some good information out there for business owners straight across the country. We've got people joining us from Ontario and Alberta and British Columbia. Fabulous turnouts to these things. So I'm grateful and appreciative that people are finding this information useful and that we're able to deliver it in sort of this neat platform. A few housekeeping items. Just give me a sec here. So we've got more sessions coming up. Just get back to this. And so next week, we're doing a session called Get a Grip. And this is going to be an awesome session hosted by business coach Chris Jones, who will be talking about some practical tools to help you gain traction in times of crisis. Chris is a serial entrepreneur, and I think it's going to be a very good session. And so I hope that you'll join us for that one. The week after, it'll be me again, and I'll be talking about how to automate bookkeeping systems and how we approach doing bookkeeping for our clients, and take you through some real life examples of how technology can make business owners' lives a lot easier and get them access to the information that they need sort of in real time. And then the week after that, we're going to be talking about law. We've got a lawyer on, Nader Benaisa from Hui Lawyers in Calgary. He'll be sort of doing a crash course on what business owners need to know about corporate law, what are your obligations, et cetera. So I welcome you to join any of those. And thank you very much for attending this one. So, okay, so let's get right into the presentation here. So let's talk about corporate tax and the CRA. This is sort of meant to be a real condensed sort of crash course on corporate taxation. Again, a lot of this stuff, especially in the last couple of months, has been just so fluid and moving. It's been a real challenge to keep up. So here's our standard disclaimer for these webinars. As I was saying, things are changing, things are fluid all the time. So just be prepared for some change. So and we're not giving out advice here. That's not what this is meant for. If you want some advice, I strongly recommend that you hire us because we're very good accountants here at Aiken Henderson. So and we'd love to have you. All right, moving on. So the agenda today is we're going to talk about some of the changes that were announced in the 2019 budget. So that's going back to, sort of changes that are happening this year, pre-COVID, of course. Know your way around the CRA, your installments, tax deadlines, penalties, and interest. We'll talk a bit about what's deductible. We'll talk about record keeping, salaries versus dividends, shareholder loans, employee versus contractor, the real basics of corporate income tax in Canada. Okay, and so getting right into it here, 2019 changes, there's the electric vehicle incentive. So if you were considering buying an EV, I don't know if anybody's buying anything right now, but if you were considering buying an EV, you might, this might be a good year to do it. There's a credit available. I'm not sure how far into that program we are, but there is a expiry date on it in terms of cash flow. And I'd have to look in to see if that was canceled or extended or where we're at in the program. So just take a look at that. There's a link in there. Alberta UCP last year reversed the statutory holiday changes that the former NDP government put in 2018 and pretty much went back to what Alberta was doing originally before the NDP changed the stat and holiday rules. The new simplified income splitting rules from 2017 came into full effect. And I say simplified in sort of a sarcastic way. It's really, really complicated stuff, but that's, if you remember, that's the TOSI rules, tax on split income. So that's the rules that were announced and sort of revised and re-revised after the tax revolt of 2017. Basically, unless your spouse or kids are active in the business, you can't pay them dividends. That's those rules, if you're in a service company. The federal small business tax rate reduced to 9%, which may sound like a great thing, and it is. However, the whole marketing around it was sort of disturbing to me. So I made a video about that a year and a half ago that went viral, and you can watch that in the link. And then, of course, the Alberta general tax rate under the new government here started its decline. It's going to come down to 8% for general companies. So that's big companies. The decline's targeted for 2022. Okay, so one thing I want to point out is on the left of the screen, you can post your Q&A. I will get to those, as many of those as I can. And so go ahead and ping your questions up in there. So I'm hoping that most people on the call have logged into or have some idea about CRA My Business Account. And what that does is it allows you to look at all your account balances, transactions retroactively for several years. You can pick up your mail sent by the CRA if you're signed up for online mail. You can view your notices of assessment, all your tax balances, historical capital gains and losses. You can view your tax deadlines, calculate installment requirements, see how much you've installed. It is a very useful tool for business owners. And if you're not signed up to CRA My Business Account, you ought to be. So please go ahead and get signed up for that as soon as you can. The next one is CRA My Account for individuals, very similar to business account. You can get at historical personal tax returns and notices of assessment and reassessment. You can see your CRA account balances and transactions. You can look at all your T4s, T5s, your T4 RSPs, your T4 RIFs. A lot of your slips are actually submitted to the CRA by whoever the payor is in either on the due dates are either February 28th or March 31st, and you can actually go and pick those up. So if you think you're missing a T-slip from one of your employers or an investment you have, you can go into the CRA and have a look and see if it's in there. We do that for clients all the time. You can see a full list of your eligible benefits and credits. Are you eligible for the disability tax credit? Are you eligible to claim that for an eligible dependent? You can see tuition carry forwards, RSPs, room, TFSA contribution room, etc., and view your mail from the CRA. So very, very handy for individuals. So, make yourself a note. If you take nothing else away from this presentation, sign yourself up for CRA My Business Account and My Account for Individuals. Okay, so program identifiers. So when you sign up your company for a corporate account, it'll be a 9-digit number followed by RC0001. That's the federal corporate account. If you are in Alberta or Quebec, you're going to have to file your own provincial returns. We'll get to those in a minute. But your GST account will be the same 9-digit number. It'll end in RT0001, and your payroll account will be RP0001. And these numbers appear at the top of every piece of mail that you get from the CRA. So if you're ever wondering what account it relates to, that's how you know. And then, of course, when you log into My Business Account, you'll see those accounts. All three of those accounts are in there as well. And then provincial, if you're in Alberta, your provincial corporate account number will be listed on your certificate of incorporation. And then a personal, of course, it's your social insurance number is your account number with the CRA. Okay, so I'm not sure if you knew this, but the CRA does not write the tax law. They are simply the enforcers of the tax law. They're like the tax police. And so how it works in Canada is Parliament passes laws and writes, they issue and pass the tax laws, and then the CRA are responsible to enforce those. The interesting part about that is it leaves room to interpretation. That is, I might have a different opinion of how a law is worded than the CRA does. And so when we disagree, we end up either disagreeing and winning or disagreeing and going to court. And then a judge decides what the law means, and that forms a whole body of case law that we can refer to as well for future instances. The interesting part about this is the CFIB, the Canadian Federation for Independent Business, publishes an annual report, and I'm including a link for it here in a report card, and I'm including a link for it here. And the CRA doesn't do that good at interpreting or applying the law, and so that can be problematic when you're phoning in to the CRA to get, what should be good information. A lot of the time you can end up with the wrong answer. from the agent on the other end of the phone. And so you just want to be, that's challenging. So it's really important to hire a professional who knows what they're doing with tax law. And because even, if you're trying to duke it out on your own, the CRA often is not the best resource to use to understand the tax laws, which is really, unfortunately, it seems kind of counterintuitive. Okay, so installments. You may have gotten you may have gotten a notice that you have to pay installments. So why does that happen? So new corporations in the first year do not have to pay installments, and that can be problematic. If you're in your first year, you're making money, you're reinvesting it into the company, and you have no cash, and then the tax bill comes along because you haven't been making installments, and maybe you haven't been tucking enough away, and this can happen for persons as well. And so that is sort of the first year entrepreneur's dilemma, as I like to call it, where you've done well through the year, or you're earning income through the year, and you've spent it all, you've reinvested it all, the cash is gone, and all of a sudden you have this big tax bill. And so after the first year, if you owe more than $3,000 in corporate taxes payable or GST for annual filers, you'll have an obligation to make quarterly remittances. And broadly speaking, there's a couple different ways to calculate it, but broadly speaking, it's going to be basically what you owed last year divided by 4. And we can get into the specific calculations in a bit here. And so what'll happen is at the end of your first year, not only do you owe all this tax for last year, but you also owe your first quarterly installment. And first year entrepreneur's dilemma, the cash is gone. And so you need to watch out for that, particularly if you're in startup mode and you're doing all right. I mean, if it's just a big loss year, you don't have to worry about this. But if you're doing all right in the first year, you're going to run into this dilemma. And it isn't necessarily the first year of being in business. It could be the first year that you started making money. We've had a lot of clients where they've run losses for a couple of years getting off the ground, and all of a sudden they're making money, but their cash is gone because they've reinvested it. And now they're into the entrepreneur's dilemma as well, the first year entrepreneur's dilemma. It's the first year profitability, not necessarily operations. Okay, installment due dates. So your quarterly due dates, you'll be eligible for annual filing if you have a perfect compliance history, you've claimed the small business limit in a prior year, and together with associated companies in the current or prior year, you've got taxable income of less than $500,000. If you are in taxable capital employed in Canada of less than 10 million. If you meet these criteria, you can file annually. And if you file annually and owe more than $3,000, you're going to have to make quarterly installments. Quarterly installments are due on the last day of every complete quarter or month of your tax year. So it really follows your year end. So if you're a December year end, your installment dates will be March, June, September, December, the last day of those months. If you are a January year end, it'll be April, August, October, January. So it follows your fiscal year. So how much? Well, if you're logged into My Business account, you can log in and use their calculator to figure out how much, or you can ask your accountant. Of course, when we prepare our year-end corporate tax letters for our clients, in our letter is the legislated requirement for installments the following year. Of course, there are different options for calculating installments, but we generally go with the legislated amount. An option with installments, and this can be either GST or corporate or personal, is to say, yeah, never mind that, I'm not going to install that much. And what would be the scenario where you'd be allowed to do that? Well, you could do these. So somebody's asking if these webinars will be recorded. Yeah, everybody gets a post of these webinars afterwards, just for FYI. So don't worry. I know this is going to be a big dump truck full of information. You'll be able to refer back to this afterwards, absolutely. And by the way, our website is a great source for all this stuff. It's all published on our website. So if you want to reduce your installments because you're not going to have as good a year, you're allowed to do that. And we'll talk about what happens if you mess that calculation up in a bit when we get to the interest and penalties. But one of the options is to reduce your installments to whatever you think they should be. That doesn't mean if you get it wrong, there won't be penalties though. So we'll get to that in a second. All right. Sorry, guys. All right. So if I get installments wrong, so basically, let's say you owed $200 in installments in a year. Nice round number. And you decided that because you were having a slower year, you were only going to make $100 of installments. If you owe $100 in tax or less at the end of the year, there won't be any interest or penalties. Okay. If you owe more than $100 in tax at the end of the year, there will be interest on the delta between what you actually installed and what you owed, because they wanted you to make 200, you only made 100, it was short, therefore interest. If that interest exceeds $1,000, there can be a penalty applied as well for missing installments, and there's a calculation of it there. Hopefully, if you're a good, responsible taxpayer, you're never bumping into these penalties, but we see them all the time. Okay, so let's get into tax deadlines now. So a lot of people will already have their head wrapped around this stuff, so I'll get through it as quickly as I can. Apologies if you already know this. So source deductions are, if I've paid employees here for May 31st, the deductions on that are going to be due by the 15th of the following month. With a few exceptions, you might be eligible for quarterly if your monthly withholding amount is less than $1,000. But by and large, for most employees, these withholdings will be due by the 15th of the month following. Missing that is a big penalty. There's a 10% penalty on any late amounts remitted. Why is the penalty so severe for payroll taxes? Well, payroll taxes, CPP, EI, and tax withholdings, when you're sitting on those monies as a company, that's not your money. That's the employee's money. And so you're holding it in trust. And if you're late on that, they impose a very severe penalty. And that's why they want you to get it in on time, because it's not your money. And so, there's the penalties and interest for those. And then if you have a habit of doing this, you can have double the penalties. So it can get very, very expensive. So if you owed, let's just say you owed $2,000 in withholding taxes. Let's say you owed $10,000 in withholding taxes on a pay run. Your penalty for late remittance would be $1,000. And if you're a repeat offender, it'd be $2,000. That's for 1 month. So you want to make sure that you're following the payroll rules. Okay, general rules for tax deadlines, and then we'll talk about what's going on in the world of COVID. So generally speaking, big companies and investment companies have to have their taxes in by 2 months after year end. But if you're a Canadian-controlled private company, which I imagine most of the folks on this call today are, you get a 1 month extension on the tax payment deadline. Your annual GST return is also due to be filed in all cases 3 months after year end. And that's the payment deadline as well, is 3 months after year end. Now, interestingly enough, is you don't have to actually file a corporate tax return until 6 months after year end. And that's for all companies. So you end up in a situation where you owe the tax before you've filed the return. Isn't that interesting? So how, and I'm going, well, how on earth would we know how much tax to pay when the deadline to file the taxes hasn't even come yet? And really, it's an effort to get, you have to make some estimates. In private company land at Aiken Henderson, for example, if you were our client, we would do our best to make sure that you always had everything done and out and filed and completed by the 3 months. That's what we aim for all the time. But in big company land, my wife used to work at a public company here in town, and they would have to make an estimate and get a tax payment in for their 2 months after year end. And they would take the full 6 months to prepare their tax returns because they're very complicated. And often there'd be an adjustment. Okay, so let's just look at today's deadlines. So we got a May 31st payroll, June 15th, the source deductions are due. May 31st, if you're on a calendar quarter year end, May 31st, you've got, this shouldn't say December quarterly GST return. This should say April, sorry, I've got a typo in here. This is April 30th, and this should say March and March. Or if it was a December quarterly GST return, this should say January 31st. So excuse the typo on this one. Now, the one thing actually I did want to go back to is filing deadlines and payment deadlines for corporate taxes. They were originally extended to June 1st due to the COVID, and that's for trusts as well. It was just recently announced that it's been extended now to September 1st. So if you're late on filing basically tax returns or tax payments that were due on or after March 18th, you've got until September 1st to get those in now. So if you're sitting on late returns, you can get those in. We can help you get those in. Okay, so back to this GST return. Also, the GST return under COVID, remember this is a typo, this should say January 31st. The GST returns under COVID, anything that was due after for February, March, or April monthly reporting periods, or that was due for March, all of that has been extended to the end of June. And so if you sort of had a GST return due in Q1, you're good now until June 30th to get those paid. However, the filing deadline had not changed, but the minister has since said that the filing deadline is still, for example, March 31st for a December year end. However, if you have it filed by June 30th, they will not apply a late filing penalty. So there's a bit of an extension there as well. Okay, so just proceeding on with some deadlines, T4s and T5s are due by March 2nd. That's also your RSP contribution deadline this year. And then federal and provincial tax payments are due for investment companies and big companies, where March 31st would be your Canadian-controlled private companies, provincial and Canadian federal taxes due, notwithstanding the exception this year, which is pushing that out to September 1st. And annual GST filings would be due, and the payment is due March 31st. However, that's been extended out to June 30th this year. T3 trust returns and slips are due to be filed on March 31st. Again, COVID has pushed those out to September 1st. And then in addition to that, on March, you'd have your Q1 federal corporate tax installment due. So of everyone on the call, I'm not sure whose head is spinning yet, but this is why it's really important to have a good tax person on your team to help you sort of manage all this stuff. So moving on here, if we look at what deadlines coming up next, April 30th is the next deadline. Again, that was initially extended to June 1st, which is in a couple of days here, but that has now, the deadline hasn't been extended, but they've said if you file and pay by September 1st, you're not going to have a late filing penalty apply, so that's good news for everybody that's delaying their personal tax returns. The reason why you still want to get your personal tax returns in on time is if you're entitled to a refund, for example, you want to get a hold of that refund, or if you're entitled to certain tax credits that are set by you filing a tax return, you still want to get those tax returns in on time. June 15th, personal tax returns due if you have business income. So if you're a proprietorship, you've got to file by June 15th. June 30th is when corporate tax returns are due in Q2. Federal corporate tax installment would also be due. So I think we beat deadlines to death here. Penalties and interest we sort of talked about as well. So let's talk about a few best practices. So if you want to have a good handle on your accounting system and make sure that your deadlines are always met and that your accountant is always happy, make sure your year-end books are closed, reviewed, and delivered to your accountant within 30 days of year-end, 60 at the absolute latest. And so you want to just make sure that you're getting this stuff closed off, reviewed, and done right away after year end. Best practice number 2 is your monthly books should be closed and reviewed by you within 15 days of the following month. And that really helps you have a good handle on your business so you can see everything coming. So when you're doing your reviews every month, look at sales. Do the sales numbers make sense? Review your accounts receivable. Do those people actually owe you money, those companies? Accounts payable, do you actually owe those people and companies money? Look at your shareholder loan account. Oftentimes bookkeepers may just dump things into shareholder loan account that they don't know what to do with. And that can, if they're expenses, for example, that can be at your detriment because that will increase the amount of income that you have to report personally. Look through the expenses, the categories, make sure that everything is categorized properly, and just do a general sniff test right off the top to make sure that your income looks appropriate and your balance sheet looks appropriate. We can help you understand those things as well. Best practice number 4 is if you set up a calendar of deadlines in your web calendar to remind you to action things when they're due. There's a few best practices for you. So next, I want to talk about salaries versus dividends. So what I've done is, let's see if there's any questions here. Webinar's recorded. This is we've got a few questions about government programs, which I wasn't really going to get into on this webinar, but we'll see if we have time for that at the end. Okay, so salaries versus dividends is an interesting topic. Salaries are, there's a lot of different advantages, and I've written a 3-part blog on this. And part 1 is which one attracts less tax. A lot of people are interested in, do salaries or dividends attract less tax? The simple answer is salaries, in Alberta anyways, attract less tax. And but by the time that you factor in CPP, you actually end up behind in cash a little bit, but you've contributed to CPP. And so that's an interesting point, is if you want to contribute to CPP and have that as part of your investment strategy, and then salaries may be better for you. In my blog, I go through 3 examples at 3 different income levels, about $30,000, $110,000, $150,000, and $200,000, and I show you how those shake out comparatively and where you end up in cash and tax. But the short answer is, in Alberta, salaries attract less tax, but you're also a little bit behind in cash because of the CPP component. Part 2 of my blog discusses sort of the advantages and myths of salaries versus dividends. So the nice thing, I'm an advocate for salaries, and I think that we've seen in the recently released government programs, until very recently they've smartened up and sort of opened it up to dividend people who receive dividends. But originally it was only for people who pay salaries. All these programs that the government has announced, and I really am nervous to think about how many businesses sort of failed in the interim between when they needed that money 9 weeks ago, or whenever they became available, whenever that cash became available, I guess 2 months ago, and now when the rules got changed to allow them access to, for example, the CEBA. And so I'm a big advocate of salaries. Salaries are a forced savings plan. So this makes you withhold amounts from your salary and remit it to the government on a regular basis. So you don't end up in a situation where you're cash rich in the company or cash rich in your pocket and haven't paid your taxes yet. Also, as we discussed before, there's a preferential tax rate on salaries. If you are a fan of the CPP and you think that you're going to, that you're going to get these payouts and live for a long time, then CPP can be a pretty good deal. And so maybe you want to contribute to CPP. You do not contribute to CPP through the payment of dividends, and you do not build RRSP room when you pay yourself dividends. You have to have what's called earned income, and that basically is salaries. So there's a few advantages of salaries. And a lot of people use paying dividends as sort of a cash flow management tool. We totally disagree with this approach because unless you're really, really good with money, but what it can end up doing is you end up owing a huge tax bill at the end of the year, and now the government is your financier. And I can tell you that the CRA is not a nice creditor. They're kind of like, the big guy that shows up with the brass knuckles when they need to collect. I mean, the CRA has amazing powers when it comes to collections if you fail to pay them. Also, if you want to be on salaries, it can be very complicated, right? So that's sort of a myth, because there's software now that is incredibly affordable that does all the payroll calculations for you, takes the money out of your corporate account, plops it in your personal account, sends the money to CRA, issues you T4s at the end of the year. Very, very simple. And so there's a few myths about salaries versus dividends. And we've kind of already talked about part 3 of this blog, which is the dividend trap. And that is where you just pull money out of your company whenever you want. You use it as your personal bank account. That, more times than not, has bitten private company owners because they didn't realize that they're going to owe a pile of tax on that at the end of the year. And so, and I call that the dividend trap. And so you can come and read about the dividend trap here. But for now, we will move on. Oh boy. Get caught up here. So what is deductible for tax purposes in your company? Nothing. actually. The opening preamble to the first section in the Act that addresses deductible or deductibility of expenses says nothing is deductible unless it meets a few of the following exceptions. And so it's interesting wording in the Income Tax Act to say we're only going to allow deductions if you meet these exceptions to the rule that nothing is deductible. And so, the main one is basically that, it's for the purpose of gaining or producing income. So let's talk about this for a minute. So what about driving to the office? Anybody have any ideas about whether or not that's deductible? It's not. To and from the office is not deductible. Directors' fees paid out to children's shareholders for directing of the company. Yeah, generally those would be deductible. How about legal fees to incorporate a business? That would be considered capital in most cases, but there's recently been in the last few years, they've changed it to allow up to $3,000 as an immediate write-off. And then the remaining goes to a CCA class that is capitalized over a number of times. Everybody knows about meals and entertainment, and it gets limited to 50%. My suspicion is because the government's tired of looking at meals and entertainment, but I'm sure there's a better excuse for it. Golf is completely limited. You cannot deduct green fees whatsoever. Penalties and fines paid to the CRA, Alberta Finance, those are not deductible. So there's a lot of things that are and aren't deductible, but generally speaking, for most things, you can come back to the rule of, was the expense incurred for the purpose of gaining or producing income from the business or property, in the case of a rental, et cetera. And so the other thing to consider is, does it have an enduring life that more than a year and it's greater than $500? You might want to check in to see if that's a capital item, which needs to be expensed over a number of years. So what's deductible? That's a complicated question, but generally speaking, it's got to be incurred for the purpose of gaining and producing income. Record keeping. The CRA has some really good guidance on this, and you'll see on the website as well. We've got an FAQ page that has all this information, but the CRA requires that you keep sales receipts, register tapes, receipts, bank deposit slips, fee statements, so like your bank statements, contracts. Your expenses need to, this is an interesting one, your expenses need to have the date of purchase, the name and address of the supplier, a full description of goods, and the vendor's GST number if they are registered. So when you're submitting, for example, when you're submitting a receipt to our automated accounting system, if we do your bookkeeping, and it's one of those little Visa receipts that prints off the Visa machine and you snap a picture of that, that is not good enough because there is not a full description of the goods. Oftentimes the vendor's GST number is not displayed on there, nor is the GST broken out on those receipts. And so we generally recommend when you're submitting a photo of something to our automated accounting systems that you snap a picture of both the itemized receipt as well as the Visa receipt in a single picture, and then we'll figure it out on the back end. In terms of property records for the sales of buildings or any other real property, you want to have the date of the transaction, the amount of the payment. You got to keep your bank statements. You got to keep your major agreements. If your minute book's not in order, that is with your shareholder register, your share certificates, articles of incorporation. You need to attend our session on June 17th to hear about what your requirements are with the law in owning a corp. And then vehicle purchase, building leases, all the lease agreements, everything. You got to keep all of that stuff. So motor vehicle records, this is a good one because everybody hates keeping a logbook. Everybody hates keeping a logbook. The logbook that the CRA wants to see, should you ever get audited, has the date of the trip, the destination, the purpose, and the number of kilometers driven. They've kind of made a concession and said, listen, if you've got a full year of good, clean logbook, that's your base year. Now you can use a quarter. And if it's fairly consistent, you can use that for the entire year. You keep a quarter per year, right? If it's within a 10% range. So that's sort of an administrative concession that the CRA has made. How can we make this easier? Well, I've got QBO turned on my phone at all times, and it just tracks everywhere that I drive. I guess that's sort of a mixed blessing, because now I've got 60 trips to go through and maybe 30 of them are business related. But you go through and categorize those and it spits out a nice clean logbook with GPS tracking and everything. So use technology where possible to maintain a logbook so that if you forget to turn something on, it's doing it for you in the background. Electronic is okay. So with our automated bookkeeping systems, when you're submitting a photo to us for your bookkeeping record, and we're creating a nice clean audit trail for you in your bookkeeping records, that's okay. The CRA accepts paper format and later converted and stored in an accessible, readable electronic format. What does that mean? It's got to be an accurate reproduction. It's got to have the same information as the paper on it, and the details of the images cannot be obscured. So it's got to be a clean picture of whatever, but that is acceptable to the CRA. Okay, let's see if we have any new questions here. Nope. Okay, I'll get back into this then. So let's talk about shareholder loans, the dreaded shareholder loan. So a shareholder loan is effectively, it's your personal, a lot of people treat their company as their personal bank account, and they just pull money out whenever they want, or they put money in to fund the company. And that money that is coming out or being put back in is either being used for personal purposes, not business purposes, or it's coming from their personal cash. So if you've got some after-tax money paid that you earned from an office or employment, or maybe you've earned it from your company and it's sitting in a personal account and tax has already been paid on it, and you put that into the company, that'll create what's called a shareholder loan payable. So that's where you've lent the company money. For whatever the company needs the money for, you, the shareholder, have lent it money. That can take a lot of different forms. You can contribute cash to the company. You can be paying for company expenses on your personal credit card, for example. Perhaps you use your personal car for company purposes, for business purposes. That amount can get credited to shareholder loan, as can the use of your personal home and cell phone and other personal things that you pay for personally for business purposes. That would create a payable from the company to you. The company owes you money. Whatever that balance is, as long as it's a credit balance, a negative balance on the right side of the T chart, that's the amount of money that you can draw out of the company without incurring any taxes, because the company owes you that money. So shareholder loan payables, credits, negative, right side, those are good. Shareholder loan receivables, debit, positive, left side of the ledger, bad. And that's where the shareholder loan has taken money from the company, usually to fund personal items. In this case, the shareholder owes the company money. The income tax has very specific rules about this. Broadly speaking, if you borrow money from your company, it's deemed to be income to you immediately when you borrowed that money. And so let's say you drew out $10,000 for personal spending. That's a loan that you owe to the company, and they deem it to be income to you at that moment in time. We'll get to the dividend thing in a second. So there's also a couple of rules later that says unless you've repaid that within 1 year. So if you've paid that after the year end. So if you borrow the money in August and the December year end passes and you repay it by the following December, you will not have to bring this into income. There's another provision which deems there to be interest on that amount borrowed. What does a repayment look like? Well, this is where your accountant steps in and says, actually, since it's going to be deemed to be income anyways, you have no intention of repaying the cash. We're going to call that a dividend, and then you're okay. And that's usually where a dividend derives from in private company land. The other option, of course, is to declare a bonus, which is a bit more involved, but it is another option for clearing a shareholder loan receivable balance. Okay, so we covered that already. Okay, we'll look for any questions here. Nothing so far. Okay, except for this one on the CERB. Hang on, Anonymous. I may get you there by the end of this thing. Employee versus subcontractor. So why do corporations prefer subcontractors? Well, they prefer to not deal with labor regulations, certain labor regulations, overtime, vacation, etc. They prefer not to calculate, withhold, and remit CPP, EI, withholding tax. They prefer not to file T4s. Corporations cannot legally be employees. So what companies often do is say, if you're going to come be a subcontractor for me, I don't want to have the argument with the CRA about whether or not you're a subcontractor. So please incorporate a company. We'll hire your company, because it is legally impossible for a company to be an employee. And so that shifts the responsibility of all this withholding and a whole bunch of different set of rules from the company that's paying to the subcontract company. And then we get into an issue called the personal services business. So a personal services business broadly says, if it looks like a duck and quacks like a duck, as in if you look like an employee and smell like an employee and quack like an employee, I guess, I don't know if employees quack, you're an employee. And if you've got a business inserted between you and the payor company, you're going to be deemed to be a personal services business, which effectively is an incorporated employee. What happens if you are the subcontractor and you're in that position? Well, a lot of your expenses are denied. So that'll be any deductions that you claimed that you wouldn't otherwise be able to claim as an employee, they're denied, as well as your small business deduction. And so in Alberta, your corporation that you incorporated to be a subcontractor, if you're a PSB, is taxed at the top personal tax rate, which in Alberta is 48%. And so generally speaking, for people who are in this position, our broad advice is to pay everything out that you've earned as employment income, because that expense won't be, that deduction won't be denied. And so you make your company income zero and move all the income to your personal name, which is where the CRA wants it to be anyways. So that's enough on employee versus subcontractor. If you have questions on that, just post it in the Q&A. Let's go through a test of who's an employee and a subcontractor, and then we'll be done with it. So first is there's intent. And everybody thinks that intent gets you totally off the hook. I intended to be a private or a subcontractor, not an employee. Sorry, that doesn't get you off the hook. That's a factor. The intention is certainly a factor. But they also look to the level of control that the payer has over the worker's activities. Employees have a lot less autonomy than subcontractors do. And so how much control does the payer have over the subcontractor, the worker's activities? Does the worker or the payer provide the tools or the equipment? So if the subcontractor is showing up with a van full of tools all the time, there's a good chance that they would be legitimate subcontractor. Whereas if the payer is providing all the tools and equipment, the laptop, the office, the phone line, all that stuff is considered. So does the worker, can the worker subcontract the work to other people? So if you go, I'm a subcontractor, I'm not going to come in to work today, I'm going to send Steve, would the payer be okay with that? And then the degree of the financial risk that the worker takes. I mean, if their pay is guaranteed, and if the payor starts doing poorly and they're still paying the bills, even though, they look at that. And so does the worker have an opportunity for more profit? And any other relevant factors such as written contracts. Again, people think a written contract gets you out of being an employee. It's like the last factor on a very long list of factors that they will look to as a written contract. So a written contract is not a home run. So I think that's everything we wanted to cover today. I am hoping for a few questions over on the right, anything to do with tax. Let me just look at this one that came in here to do with, sorry, give me a sec here. We'll flip me back up onto the screen and see if we have any questions. So, okay, may I ask your thoughts as in the Ontario OHIP is giving a monthly loan for 3 months. Do you think this affects our eligibility for the CERB? I have no idea. I'd have to dig into that one and look specifically at that. So I'm sorry, I don't know. You would want to maybe check with your accountant on that one. Does anybody have any questions about tax on this? Okay. Well, if anybody has any questions at all, we're here to help. Anytime you want to reach out, you can email me personally. You should all have my email, or you can reach out to info@aikenhenderson.ca, or just visit our website. It is a wealth of information. We've put together a fairly robust website for private company owners. And any way we can help you, we will. And another great resource is to follow me on LinkedIn. I'm posting stuff all the time about government updates to do with COVID and anything else that might be useful for private company owners. So thank you so much for attending. I hope you found it useful, and have a great day and a great weekend.